What a day yesterday. We managed to, hold out at that 25,000 mark for the better part of yesterday's trading session. So now it's just a mathematical level. We're almost pretty much at an all-time high. Just want to take a status check, though, on what the global markets as well have been up to. While yesterday, of course, it was IT, metals, they were all chugging along nicely. It was a great day for even the global, or rather the broader markets. It was not like it was a Nifty alone move. But just want to take status check of what the global cues are looking like, because you are seeing the US futures at least edge a little bit lower. There are, of course, key earnings that the street as well is eyeing. There's also US durable goods orders, which have rebounded sharply, but you're not really seeing much of a movement come in, at least for the US futures. Talking about the handover though overnight, and it was a bit of a mixed bag. It was quietish for the Dow, marginally higher, a little bit soft for the S&P 500 index, and the Nasdaq was the one when you saw a deeper, dip, about 150 odd points in the red. Having said that, this morning Asia is pretty much all a sea of red. You've got China industrial profits, which are in focus. That data is awaited, and across the board you are seeing about a 0.5% kind of cut coming in. No wonder then the GIFT Nifty also is indicating once again a very, very quiet start. But then again, quiet it was yesterday as well. And look what we did.
Yeah, I mean, you've really summarized it brilliantly, that in terms of what the market setup is, which is that hardly anything big, no news event. It's pretty much status quo in terms of where we are. A little bit of shakeout here or there. That Fed rally, which we thought would last and linger along for a while, that has not translated into a giant move, so to speak. So status quo from global market. It's not a solid handover, it is not a weak handover, but the gains, I guess, of late have been solid. You are at an all-time high. The difference between the last all-time high versus now is that PSUs are on a backseat. Pharma is where the action has started. Autos are taking it easy. IT has been surprisingly resilient. And last couple of days, banks and NBFCs are showing signs of strength.
Okay, and yes, indeed, no major moving parts, but look where we ended up yesterday, as Aisha said, 8th straight day that we managed to see gains, and 25K on the Nifty as well being held on to, and this after a period of 3 weeks. So we've clearly marched towards those life highs, and you could say that this has been the longest winning streak that we've witnessed in over a year. What has obviously helped is the fact that you have seen the FII total longs, which are at a 14 session high, and the DIIs, Nikunj, they've really been propping the markets, a net buy figure for the 16th straight day.
Yeah, it's a liquidity-driven market.
Yeah.
That's what I can say, and everybody knows that. I'll not say anything new. But what our realization of late has been, and after we, spoke to Firoz Aziz and others, is that it's not only the DI liquidity. There is NPS which is at play. Now promoters are also selling a lot of equity. So that promoter money indirectly is coming back into equities. It is coming back into PMS. It is coming back into mid and small cap funds. It is coming back into P investors and investments. All that is also fueling. It's like when a promoter is selling, that locked up share comes back and they're investing in other assets via family office. That's second. Third, there is money which is coming from LIC. LIC chairman told us that this year they're looking at nearly 1 lakh crore of fresh inflows or investments. That's the third part. And the fourth part, which may just be, adding more muscle to the market, I think is going to be NPS. So all that put together, really, you are in a situation where liquidity is abundant. FI selling is getting covered up despite liquidity, and whatever promoters are selling, it is getting absorbed. So whether it is the brute force of liquidity or the compulsions of the market, I guess this market is by and large convinced that in the near term, barring a global risk-off event like we saw on 2nd of August, I think we are in a good steady shape, so to speak.
Right, okay, that's marching towards a life high, not really away from that level. We're just about 0.3% away from that mark. So almost pretty much there in any case. The Nifty Bank, of course, I think that's the weak point, and the mid-cap 150 index as well, because the Nifty Bank underperformance, Nikunj, looks even more stark if you were to compare it with, say, a Nifty, which is barely there away from its all-time high, and it's a good 4% lower for the Nifty Bank.
Yeah, Aisha, that is the only sort of wrinkle, so to speak, or even like I would use the word, not even a wrinkle, a fly in the ointment. Yeah. And nothing more than that. And that is really because of technical, factors. Banks are underperforming because FI is selling. B, banks are also going through what really could be called as a bit of a challenge because the liabilities are not coming or the cheap deposits are not coming, money is moving into financial assets. C, the government or RBI in a sense has already indicated that they need to go easy when it comes to the entire unsecured loans, and liquidity is getting tight for NBFCs. So there is a technical factor which is FI selling. There is a earnings factor which essentially is that where liquidity is going to move, and then there is the NPA concern. All these things put together, I think the underperformance in the Nifty, I think the bank Nifty, I think is getting more and more realistic, and markets are now digesting also that just because it has not participated anywhere, it does not make it exciting. I think what we need to focus and understand is that when we were at an all-time high couple of weeks ago versus where we are at an all-time high, what has changed? And for me, I guess the primary positioning is defense and railways are not the stocks which everybody is chasing. Because the market's at an all-time high, the selling or the cracks in some of these groups is getting shadowed. For example, in 2022 and 23, we saw a linear decline in IT. But the rest of the market was doing beautifully well, that the crack in IT in a sense did not really occupy the center stage. So that's the point I'm trying to make again and again. We are at an all-time high. I mean, 30-40 points here and there doesn't matter. It's a mathematical number. But the composition of the market is drastically different than what it was when we were at the previous high couple of days ago.
Okay, yes, indeed. And that is the overall setup for the markets. But if we were to just pinpoint one sector, Morgan Stanley has actually come out with an interesting note on the real estate space where they're talking about how investor interest has waned versus what we witnessed about 6 months ago. They have said that valuations are looking stretched, although they do remain constructive, saying that the upcycle is still looking pretty strong. They're saying that still it's the retail landlords that are preferred over some of the office players. And Nikunj, is that something that is an observation in terms of the kind of investor interest and the preferred real estate picks that they're going for?
See, that's a judgment call in terms of where the real estate cycle is moving. Now I can argue back and say that, look, the exciting part in the real estate is over. But because of the wealth creation which is clearly happening in the equity market, I guess in the near term the real estate cycle uptrend will continue. So I think there is merit in thinking that the retail dominated real estate stocks will do much better than what really are the so-called non-retail dominated businesses. So these stocks have seen an extraordinary run-up, and I'm not even talking about COVID. Even if you look at, let's say, last 1 year, look at the top names here: Prestige, DLF, Max, Brigade, Loda or Macrotech. Just look at the changes in last 1 year. Prestige is up 200%, whereas Max, it's up 140%. Look at Macrotech developer, up 80%. And I'm talking about the last 1 year. It is not like I'm taking the clock back to COVID. So the run-up has been strong in some of these companies. So they deserve to take a rest, because real estate cycle is not going to move in a linear manner. But within that, if the tilt is more towards companies which have a higher presence in retail and non-luxury, I think there is merit in it. I think everybody is now just blown away that luxury will only do well and the non-luxury will not do well. I think that trade in my book is over.